Hello, everyone, and welcome back to the Babalian Money Show. I'm your host, and today we re-tackling a question that keeps a lot of investors up at night. How can you actually make money when the stock market is falling? It sounds counterintuitive, right? We're all taught to buy low, sell high, but when everything seems to be dropping, it can feel like there's nowhere to hide, let alone profit. First off, let's get a quick disclaimer out of the way. I am not a financial advisor, and this video is for educational and entertainment purposes only. All investing involves risk, and you should always do your own research and consider consulting with a qualified professional before making any financial decisions. Your capital is at risk. Now that we've covered that, let's dive into some fascinating strategies. The most common reaction to a market downturn is panic. You see red across your portfolio. News headlines are screaming about a crash, and your first instinct might be to sell everything to cut your losses. But seasoned investors often see these moments not as a crisis, but as an opportunity. Today, we're going to explore several ways you can potentially turn a falling market to your advantage. We'll cover everything from simple, accessible strategies for beginners to more advanced techniques used by the pros. So, let's start with the most straightforward approach, buying the dip. This isn't about trying to time the market perfectly. That's a fool's errand. Instead, it's about a strategy called dollar-cost averaging. If you believe in the long-term strength of the companies you're invested in, a market dip is essentially a sale. Think of it like your favorite store having a 20% off promotion. You wouldn't panic. You'd see it as a great time to buy. Dollar-cost averaging means investing a fixed amount of money at regular intervals, regardless of what the market is doing. When prices are high, your fixed investment buys fewer shares. But when prices fall, that same amount of money buys you more shares. Over time, this averages out your purchase price and can significantly lower your overall cost basis. This disciplined approach removes emotion from the equation and turns a downturn into a chance to accumulate more assets at a discount. If you have a long-term horizon, say 5, 10, or 20 years, this is one of the most powerful and stress-free ways to build wealth. Now, let's move on to something a bit more active, investing in defensive sectors. Not all stocks fall at the same rate during a downturn. Some sectors are considered defensive because they provide goods and services that people need regardless of the economic climate. Think about it. Even in a recession, people still need to buy groceries, use electricity, and get medical care. Companies in sectors like consumer staples, food, beverages, household products, utilities, and healthcare tend to hold up better during market slumps. Their revenues are more stable and predictable. So, while high-flying tech stocks might be taking a nosedive, companies that make toothpaste or provide electricity are likely to be much more resilient. Shifting a portion of your portfolio into these defensive stocks can help protect your capital and even provide modest gains while the rest of the market is struggling. You can do this by buying individual stocks or by investing in sector-specific ETFs, which offer instant diversification. Okay, let's talk about another asset class that often shines when stocks are falling: bonds. Bonds are essentially loans you make to a government or a corporation. In return, they pay you periodic interest, and at the end of the term, you get your principal back. High-quality government bonds in particular are often seen as a safe haven asset. When investors get scared and pull money out of the stock market, they often move it into the relative safety of bonds. This increased demand drives bond prices up. This is known as the flight to quality. So, while your stock portfolio might be down, your bond portfolio could be up, acting as a crucial buffer and stabilizing your overall net worth. Having a balanced portfolio that includes a mix of stocks and bonds is a cornerstone of smart investing, and its importance is never more apparent than during a market correction. Now we're going to get into some more advanced strategies. These require a bit more knowledge and risk management, so they might not be for everyone, but it's important to understand how they work. The first one is short selling. Short selling is the act of betting asterisk against asterisk a stock. Here is how it works. You borrow shares of a company that you believe is overvalued or likely to fall in price. You then immediately sell these borrowed shares on the open market. Your goal is to wait for the stock price to drop, at which point you buy the same number of shares back at the lower price to return them to the lender. The difference between the price you sold them for and the price you bought them back at is your profit. For example, if you short a stock at $50 and it falls to $30, you can buy it back and make a $20 profit per share. This is one of the most direct ways to profit from a falling market. However, it comes with significant risks. Unlike buying a stock, where your maximum loss is the amount you invested, the potential loss on a short sale is theoretically infinite. If the stock goes up instead of down, you still have to buy it back to return it, and there's no limit to how high a stock price can go. It's a high-risk, high-reward strategy best left to experienced traders. Another sophisticated tool is using inverse ETFs. ETF stands for Exchange Traded Fund. Most ETFs are designed to track a market index, like the S&P 500. If the S&P 500 goes up 1%, the ETF goes up 1%. An inverse ETF does the exact opposite. It's designed to go up when the market it tracks goes down. So, if you believe the entire market is headed for a downturn, you could buy an inverse S&P 500 ETF. If the S&P 500 falls by 2%, this ETF is designed to rise by 2%. This allows you to profit from broad market declines without the complexities and unlimited risk of shorting individual stocks. However, there's a catch. These are complex financial instruments, often using derivatives, and they are typically designed for short-term trading, not long-term holding. Their performance can deviate from the underlying index over longer periods due to a phenomenon called beta slippage. So while they can be a powerful tool for a day or a week, they are not a set-it-and-forget-it investment. Let's also talk about options, specifically buying put options. A put option gives you the right, but not the obligation, to sell a stock at a specific price called the strike price before a certain expiration date. You can use put options in two main ways during a downturn. First, as a hedge. If you own 100 shares of a company and you're worried it might fall, you can buy a put option. If the stock price does drop below your strike price, the value of your put option will increase, offsetting some or all the losses on your shares. It's like buying insurance for your portfolio. Second, for speculation. If you don't own the stock but believe it's going to fall, you can simply buy a put option. If you're right and the stock price plummets, your option becomes much more valuable and you can sell it for a significant profit. Options offer incredible leverage, meaning a small investment can control a large position, but they are also risky. If the stock doesn't fall below the strike price by the expiration date, your option expires worthless and you lose your entire investment in that option. So to recap, we've covered a wide range of strategies. For long-term investors, dollar-cost averaging into strong companies and rebalancing into defensive sectors and bonds are time-tested, sensible approaches. For more experienced traders willing to take on more risk, short selling, inverse ETFs, and put options offer powerful ways to potentially profit from falling prices. The key takeaway is that a falling market doesn't have to be a disaster. With the right knowledge and a clear strategy, you can protect your portfolio and even find opportunities for growth. The worst thing you can do is react emotionally. Instead, have a plan in place before the downturn happens. Know your risk tolerance, understand your time horizon, and be familiar with the tools available to you. Thank you so much for joining me on the Babalian Money Show today. I hope you found this breakdown helpful and that it gives you more confidence in navigating any market condition. If you got value from this video, please hit that like button. It really helps the channel out. And if you haven't already, make sure to subscribe and click the notification bell so you don't miss our future videos on building wealth and mastering your money. Drop a comment below and let me know which of these strategies you've used or are most interested in trying. Thanks again for watching, and I'll see you in the next one.